Lena Komileva is a managing director and chief economist at G Economics. Her insights are read by central banks the world over, including the Fed and the Bank of England as well. Lena, good morning. Thank you for joining us. How much damage has been done to both deposit and creditor confidence within the Eurozone because of this Cyprus deposit tax?
Yes, the tax on deposit is really a government default by another name. But more than that, it has huge long-term systemic implications because it goes right in the heart of the notion of an integrity of a banking union, without which the Eurozone would not exist. It introduces policy risk, political credit risk back onto the table, something that investors had thought had disappeared under the ECB's whatever it takes to save the euro umbrella. And it also introduces something else. It introduces a new risk premium to non-euro originating deposits. Whether it's Russia or somebody else, it's quite clear that under the veneer of market normalization that we've seen in recent months, the default cycle continues, and that default risk will hit those parts, if you like, of the financial system that are least democratically represented. Which actually brings me to my next point, and that is that quite clearly bank depositors are only as safe as the willingness of domestic taxpayers to take on some of the burden sharing. In other words, if the protests in Cyprus today succeed in changing this badly designed tax on deposits structure that's currently on the table, bank creditors and non-euro depositors are clearly going to be the ones taking up that increased financing need.
So does that mean we're going to have a division between, let's call them, the good banks and the bad banks?
Absolutely.
Within the Eurozone?
I think the credit differentiation is clearly back on the table, and with that, market fragmentation is back. I mean, the notion of capital controls is also here, because so far we've had a run on European risk markets, and we've also had a wholesale run on the European banks as creditors are anticipating the next shock, the next phase of this fallout. The problem with this deposit tax in Cyprus is that it does neither of the two things that it's supposed to do. It neither restores faith in the stability of the Cypriot banking system, quite the opposite, nor does it really create a sufficient and adequate economic backstop. It's created a very contagious confidence shock, which is still to unravel, I think.
So let's look at the unraveling. Lena, what happens next in this Cyprus crisis? How does it spill over into the rest of Europe?
Well, the markets hate uncertainty. Yeah. The best really position that we could have, and we haven't had through any Eurozone credit bailout so far, is a position where the markets can take stock of the whole bad news, price in the risk and move on. We thought we had done that in the past year with the ECB saying, look, we're going to take any tail end risk and insure it through our balance sheet. Quite obviously this is not going to be the case, because what Cyprus has shown is two things. First, that the Eurozone banking system is still only as strong as its weakest link. It's extraordinary. We're talking about an economy that's less than half percentage point of the Eurozone's economy here, Cypriot economy. And second one is that clearly monetary liquidity has not outsourced the problem, the credit risk that depositors and, in fact, all bank creditors hold.
Isn't this a message, though, Lena, from European politicians that some banks have got too big? As we know, the assets of Cyprus banks are 7 times GDP. That's a massive number, isn't it? Isn't this the core message from EU politicians, that these banks have got too big? And Europe, our message is clear. You know, you've got to downside. I know you're deleveraging, but we need to see more of this.
I think that's just why this crisis is still with us. The anatomy of this crisis is very different from the crisis we had back in 2008, 2009, the last banking crisis. And this is why the contagion will continue to spill over into the rest of the global financial economy, given the interdependencies. And that is that we don't talk about a bailout, we're really now officially talking about a bail-in across the board. The way the Euro credit story is unraveling is that local European policy officials will introduce as much risk into the local creditors' balance sheet as possible. Why? Because national budgets are no match for the level of liabilities in the financial system. Absolutely. This is an international banking system which is consistent with the European Union, which is still being backed up by domestic depositors. When we talk about the tax base of a country like Cyprus, it's pretty clear. So the approach so far has been to try and introduce as much of the burden, keep as much of the burden contained within the domestic economy, and only really cover whatever contagion risk might be perceived through the European bailout. The problem, however, is that you cannot really, this is a triple hit to the Cypriot economy because of the direct tax on deposits that's still on the table, because of the 10 billion additional debt that will have to be paid back at some point, which is clearly unpayable, because of the austerity program that will follow, that will be socially unsustainable, and because ultimately, without backstopping confidence in the future of the economy, this is we're destroying the very fabric of the Cypriot economy. It's an economy that's very much dependent on financial inflows, on